afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast. On today's webcast, as always, we are joined by our Chief Investment Officer, David Burrows. And David will be pleased to provide us with a brief macro overview, of course, and in considering that the market has had some consolidation over the last few weeks. So Dave will break down the data, and we look forward to hearing his overview. At the tail end of the conversation, we would be pleased to address your questions, so don't be shy. You can send those questions via the Q&A or the chat on the Zoom link. And with that, I turn the conversation over to the one and only David Burrows. Good afternoon, David. Great to see you.
Hey, Pamela, how are you?
Wonderful. Thank you.
Well, thanks everybody for joining today. It's been sort of a quiet 3-4 weeks in the market. Internally, there's been a bit of churning. A lot of stocks haven't made much progress. Some stocks have pulled back. The question is, how much should we be concerned? What are we doing about it? And of course, the purpose of this webcast each week is to delve into the market internals and take a look at what we see going on and just review how our portfolios line up on a relative basis and what we're doing to change positioning. From a big picture perspective, we've been of the view since 2013 we're in a secular bull market for stocks. It was kicked off in the U.S. Other global markets have joined in the rally along the way. Of course, there's been some big cyclical corrections and bear markets along the way. But as we sit right now, we continue to be above this rising 200-week moving average. Most recent touchdown was in October of 2022 in the midst of a 25-month cyclical bear market. And as of January, we ticked above and made new highs, which likely, in our view, means we've kicked off 2 to 3 years of relatively lower volatility markets. Now, the nearer we are to a cyclical correction, the more worried people are that we're going to go back into one. Generally, it means that there's some money on the sidelines. Generally, it means people are there to maybe buy the dips because they have missed, the first few months. But the net of it is, on the month, the S&P is at 3.3%. Doesn't always tell all the story. We can see that really we had a little pullback in the month of April. My screen has a mind of its own. And then reversed back up in the beginning of May. Market rallied through May, and here we are in June. About 4 weeks ago, we had some weakness in some of our internal breadth data. So we'll talk a little bit about that. It's funny, my screen is bouncing all around. But last week, we were highlighting the fact that the equal weight S&P has been unable to make a new high since April, early part of April. So we know through April, we had about a 5.6% pullback in the broad index. And we have had some rally attempts since then, but the equal weight is sort of in this consolidation range. Now, one of the things I'm going to touch on today is that markets correct in two ways. They correct in price. None of us like to see that. And they correct in time. When things get a little ahead of themselves, when we get extended long way above the moving averages, very often the markets have a way of just chopping their way sideways. And we never know what kind of correction we're going to get. As it appears right now, the average stock has been working its way sideways really since the end of April. Of course, there are some really strong stocks, and we know the names of some of those, like Microsoft and NVIDIA, Broadcom. A lot of it has been made of the fact that there's a small number of stocks leading the market, as Jim Skatakis pointed out this morning, and he's dead right. About 30% of stocks in the S&P are beating the S&P so far. So it's not 10 stocks, 30%, about 150 companies ahead of the S&P. That's not a terrible market, but it's a narrow market and one we would love to see broad. So we're watching for that. When we look outside the U.S., the Japanese stock market kicked off a very good rally a couple of years ago. We continue to mark our way higher. We pulled back in the month of April. May was higher. June is higher. We've been putting in a series of higher highs and higher lows. That's very constructive. When we look at India, well, India just keeps charging ahead. The EPI ETF, which is a representative of strong earning companies in India, has been marking its way higher almost monthly through the course of the year. It is interesting that the US is not the only game in town. There are opportunities outside. Some of it has to do with some of the sector weights of some of these markets. Taiwan, on the back of stronger semiconductors, has had 4 or 5 months straight higher, and certainly looking bullish after many years of chopping its way sideways. We talked a little bit about the Eurostoxx 50, and this is the last 4 months. So, after 1, 2, 3, 4, 5, 6 straight up months, we've had 3, 4 months sideways. But, we're at the top end of the range on the monthly chart. I don't think that looks bearish. I think it looks quite bullish. That's a time correction, 4 months. But, we're watching to see what the next move is. The TSX is very similar to a bunch of these markets, partly again because of the makeup. So stocks in general, we're bullish, long-term bullish. These are long-term multi-year charts. Doesn't mean we can't have little pullbacks. We talked about the fact the market can have on average 5% pullbacks over the course of the year. Often can have a 10% pullback. I don't expect that given the fact that we've just recently moved back into a cyclical bull market, but we did have 5% pullback in the month of April. When we look at fixed income, we saw a generational low in interest rates. That's a 10-year bond yield in 2020. We've been working our way higher since then. Very different looking picture than 1981 through 2020. Then we saw higher highs and higher lows. We continue to see that. When we look at the chart of the TLT, which is the US long bond, it has been trading below all of the moving averages, lower highs and lower lows. Sort of an interesting point we're at right now, even though the moving averages are all pointed lower, we are above the 50-week moving average for the first time, well, since this sell-off began. So we'll see if this develops into anything. The bond market may be sensing, some slowing in some of the economic data, or it may be that the inflation data is coming down a little bit. We've had somewhat more friendly PPI data. But bond market's still in a bear market. Moving averages are all moving lower. It's an asset class we're not that interested in currently. And when we look at it, we're really only not far off the lows registered back in the fall of 2023. So pretty easy when you look at this chart. Stocks versus bonds, the S&P 500 versus the aggregate bond index up and to the right. That's stocks outperforming bonds. It's been our view. Really important to have equity exposure in a world of rising prices. We want to be hedged against a rising cost of living, and companies have the ability to raise price. Importantly, dividend growth stocks for income investors have been better than both bonds and high dividend paying stocks that act like bonds. Higher highs and higher lows, and that continues. So our focus in our income strategy, we run a tactical income strategy for those that don't know, has been dividend growth. And since the middle of March 2023, when the market started to broaden out, aggregate bond index up 2.72%, the high dividend paying equity index up 17%, and the Barometer tactical income strategy up about 27%. That's all driven by dividend growth. When we move on beyond stocks and bonds, commodities, made an important turn in 2020. They were held up and consolidated, again, a time correction while central banks were raising rates. We came up and out of that. We've had 1, 2, 3 months now where we're making higher highs. We're up marginally in the month of June, but it's positive. When we compare commodities versus bonds, again, higher highs and higher lows. So when we look for a way to hedge our equity portfolios, one thing we worry about is falling prices. In a world of falling prices, bonds tend to do pretty well. In a world where the cost of living is going up, commodities are a pretty good hedge to hedge against inflation. And that's what the market is telling us. So commodities relative to the equal weight S&P up higher this month than the equal weight S&P, and that I think is an important turn. You can see the moving averages are all slowly hooked higher here. Now, what's driving that? Well, the thing this month really has been better crude prices. We talked about the fact that a lot of the commodity prices were pulling back into rising moving averages. Crude prices did pull back into a rising 200-month moving average. And we've rallied off of that over the last few weeks. 200-week moving average. If I look at the point figure price chart, this is 2024. We had a series of lower highs and lower lows, but we've just reversed and broken a triple top to the upside. That puts us back in an uptrend in crude futures. And we've had, over the past 2 weeks, better performance in oil and gas producers, certainly outperforming the market, and we're seeing a little bit better flows. So that's interesting. In the world of gold, after breaking out, having 3 sharp moves higher over the course of the last 3 months, breaking out of this cup and handle formation, sideways so far, basically on the month. But again, we're not going straight higher. We're going to move higher. We're going to consolidate, move higher, consolidate. But I would say that's overall constructive. This is, excuse me, the last few weeks consolidating that initial move higher. So bias is higher. So energy and metals prices in general higher. If we take all of the major strategies that we're running and compare them to the benchmarks so far in the year, TSX up about 5.7%, the equally weighted S&P 500 up 5.8, aggregate bond index up 0.8, the income portfolio is up 14.3, equity portfolio up 14.7, and our global equity portfolio up 8.24. So I think what's happening is that the portfolio has been focused in areas of market leadership. Certainly not perfect. We lost a few positions over the last few weeks, not a lot, but we have to manage the portfolios position by position. We don't have to be everywhere. Remember that we're targeting market leadership, areas of the market that are being revalued based on some structural change that taking place. Our job is to identify those areas. They might be sectors or themes, geographic regions that are benefiting from some shift. Now, we're always watching for change, new leadership to emerge, or frankly, old leadership to start to recede, which might mean we need to reposition. In the absence of leadership, we're very happy to sit on our hands or have big cash positions at certain points in time. We use our top-down tools to try to identify what the productive neighborhoods are. Where is it that there's money getting put to work? And we measure that using the breadth models that we have. And then we try and populate the portfolios with single securities that meet our business fundamental and technical tests. Fundamentally attractive, good getting better, where we can see price is doing what we would expect it to do, given what we think we know. If we think something looks wonderful fundamentally, but the price chart is weak, we will assume that there may be something we don't know. We want to see strong technical price patterns, and we want to see fundamental data that shows something's changing for the better. And then we want to watch that basket very carefully and be willing to carve out the stuff that doesn't work quickly before little mistakes turn into big ones. The top-down work is all about finding parts of the market where over time a higher and higher percentage of stocks are participating. That means money's getting put to work. No bear markets ever take place. That's the case. When we see deterioration in breadth, let's say we're looking at a sector and 80% of stocks are headed higher. If the weaklings start to peel away and break down technically, even if the leading stocks continue to be great, it makes us a little more cautious. It means we stop putting any new money in that bucket. It means that we go back and look at the existing positions and make sure we have very clear, defined sell limits where we would step away if the position starts not working well. And then we'll wait. We sit on our hands, and we'll only put new money to work when we get back to the point where breadth is expanding again. Now, I highlight that because of the type of market we're in. I talked about 4 weeks ago, the fact that each successive push higher over the course of the year so far got to a point where fewer stocks were trading above their 50-day moving average. In other words, the market was narrow. When we look 4 weeks ago, 3 weeks ago, you could see that a lot of our breadth data was negative. It weakened a little bit more last week. Well, this week, we got some green shoots. So as we talked about last week, when our breadth data is weakening, we don't add new positions and we scrutinize our existing positions. Last week, we mentioned we lost a couple of positions, like National Bank is one of them. Allstate was another. But in general, our positions were hanging in very well. So over the course of this week, we've got a couple of sectors that are higher, important sectors. A few stocks acting a little bit better. The percent of stocks trading above their 50-day moving average went from about 30% to just around 50%. So 20% of stocks got back above their 50-day moving average on a net basis. That's a positive. Percent of stocks above the 50-day moving average in Canada moved higher. And the percent of stocks with positive weekly price momentum, in other words, upward trajectory, went from about 22% to about 38%. So doesn't mean everything, but on a net basis, more stocks did better than did worse. So maybe it is that we've just been seeing consolidation inside the market. That's something that we have had some conjecture about. So let's look and see what's happening inside the market. Important group, technology, large cap technology. This is the XLK, which I use to represent this group. This includes companies like Microsoft, Apple, NVIDIA, Broadcom, AMD, Salesforce, Adobe, and so on. After a few months of relatively weak performance in the beginning of April, relative price performance picked up on the back of some strength in companies like NVIDIA and so on. And we had a nice move higher. Now, if we go back to where we were last week, this is Tuesday, Monday, Friday, Thursday, Wednesday, Tuesday. So we moved down a little bit over the course of the week. We've seen a whole series of higher highs and higher lows along the way. We're trading better than 86% of all the companies in the S&P. That's for the whole group. When we go underneath the surface, we talked about the dividend payers, significantly outperforming, and we've been very focused on dividend growth stocks. And of course, there've been lots of flows. Last week was the biggest inflow into technology in the last 3 years. So lots of money into this group. Now it's a little bit crowded. Certainly not everything is working. Semiconductors have been a group that we've been focused on. And this was from my friend Chris Barone at Strategas in New York, highlighting the fact that the percent of stocks trading above the 200-day moving average is in the 95th percentile. So it's not cheap. And so when this is the case, we're always watching our positions. Now, NVIDIA is a double-edged sword. It's been the gift that's kept on giving over the course of the last year. James Callahan, our analyst, has been bang on in his numbers, and they've consistently outperformed. And there's no evidence that that's going to change. But we have to keep in mind where we are technically. What I did here is I took the SOX index, which is the semiconductors index, an index of semiconductor producing companies. We looked at historically when things get stretched trading above the 200-week moving average. So in 2015, you got to 50% above the 200-week moving average, which was stretched, and you got a time correction. In 2018, we got 82% above the 200-week moving average. And again, time correction and then some price. So it was a 28% correction when it ultimately corrected. We had a big rally in 2020. We got to 70% above the 200-week moving average. Then we had a price correction, 37%. So this can be a great sector, but it has pretty significant moves. We had a great rally into 2022, 104% above the rising 200-week moving average. Then it pulled back 49%. So it's not lost on us. The group has been strong. I think we mentioned that we've trimmed a couple of times in NVIDIA along the way. The semiconductors index is 76% above the 200-week moving average. It's not 104. It's not 82, but it's extended. So we're watching it. When we look at NVIDIA, which has been obviously a champ over time, got to 163% above the 200. In 2017, it was 300% above the 200 week, 200% above the 200 week. But some of them you got a price correction, some of them you got time. Price, time. I can't tell you what we're going to see. As it is right now, it's about 300% above the 200-week moving average. We're down a couple of weeks in a row. We watched the position closely. Our position is a manageable position size. But I always say we want to stay in our winning positions as long as they continue to do what we expect them to do. And at this point, there's nothing you can point to say it isn't behaving the way that it should be. Is it extended away from the 200-week moving average? Sure it is. You know, is the group extended away from the 200-week moving average? Sure it is. But arguably, we've moved into an interesting era where AI is creating a lot of demand for semiconductors. And we have a very specific list of securities that we're in, and it's one part of the portfolio. Other parts of tech not acting so well. Low earning companies performing very poorly. Relative strength continues to fall for the more speculative high-tech companies. So what else is working? Well, financials. You know, financials had a great move higher 5 months in a row. We've consolidated 3 months. We're basically right at the top end of the band. This includes banks. JP Morgan has been a major holding of the firm, one of the top 5 positions in the firm, our largest bank position. Up over the course of this week, relative strength is maintaining a nice upward trajectory. Goldman Sachs, again, a company that we think is a great canary in the coal mine for capital market, trading better than 92% of all the companies in the S&P 500 over the last 52 weeks, up over the course of the week. Manulife, again, one of our very large insurance positions, making new relative strength high today, trading back basically to highs where it was in May, and behaving very well. Fairfax continuing to perform well. Progressive continue to perform well. The group is providing great leadership. Well, look, if the yield curve starts to normalize and the short-term money rates start to come down, and we're seeing that in certain parts of the world, and long rates stay firm, then the spread that these companies can make between the two is substantial, and that can lead to higher net earnings, net interest margins. If capital markets remain strong, then the capital markets banks can continue to do quite well in mergers and acquisitions. Industrials. Well, you can see that industrials have now had a few months of consolidation. So we've been consolidating really since the beginning of April. We're trading above rising moving averages. This is an equally weighted basket of industrials, the ETF VIS. Our positions in general are hanging in very well. Eaton Corporation, which would be our largest holding, is trading better than 93% of companies in the S&P 500. Howmet Aerospace has pulled back to a rising 50-day moving average, better than 95% of stocks in the S&P. But we did lose one position this week. We got stopped out of Finning. So let's just talk about it quickly. Higher highs and higher lows until we made a lower low. So we broke the 200-day moving average. We broke the previous low. We get stopped out of the position. Do we think it's a great company? Yes. But again, we got to manage on a position by position basis. And this one we've been stopped out of. Could we buy the position back if the technical picture got reaffirmed? Of course we could. There's lots of great companies. We just have to be willing to pair, especially when the shorter term data has been a little bit weaker. Materials. Clear cut consolidation from above rising moving averages. We're still making higher highs and higher lows. Copper ETF, after rallying 54% from early in the year, has pulled back about a third of that to the rising 9-week moving average and about the 21-week moving average. And it goes very similar to that, about 1/3 corrections. This is not out of the ordinary because these stocks are a little bit more volatile than others. The energy sector. 2 weeks ago, we said we thought we were pulling back into support. We had a sideways week. We're up this week, 2 weeks positive, 2 weeks during the fact that we've had weaker internal data in the market. So that's a positive. It's an important group for us. But the energy sector hit sort of support and bounced really nicely off. It's had a nice move higher this week. So companies like Imperial Oil, which on a shorter term basis, higher highs and higher lows, but on a longer term basis, only recently came out of a bear market that went on 2008 through 2022. We think we're in the early stages of something that looks more like what happened in the late 1990s. CNQ looks similar. So still relatively early stages and considered still seeing higher highs and higher lows, and breadth data in the energy sector, I think, continues to look pretty good. So some of the groups that have lagged, has anything really changed? Telecom, lower lows and lower highs and weaker relative strength. Consumer staples, lower lows and lower highs, weaker relative strength. Consumer discretionary as a whole, a group that's been challenged. If you have concerns about higher interest rates and potentially weaker employment data, this is a group you want to be a little careful of. Now, the biggest company in the group is Amazon, and Amazon's behaving very well. It's 23% of the ETF XLY. We are cognizant of the fact that the Fed's tightening will have, as they call, lagging effects. And we've started to see a pickup in jobless claims. So this helps us to understand maybe why consumer discretionary is behaving a little bit weaker. This last couple of weeks, we've seen some relative weakness in the home builders as we've seen housing starts start to come down, new home sales weaker. But Costco continues to perform well. Dollarama continues to perform well. Amazon continues to perform well. You have to be pretty selective. Healthcare is a defensive group, not showing up really in the work, weaker relative strength and weaker breadth, although, again, Lilly made a new all-time high today. McKesson made a new all-time high today, a new relative high. So again, you have to pick your spots. This is all about trying to identify market-leading companies. If you're in a cyclical bull market, and a cyclical bull market may go on 2 to 3 years, the leaders coming into a cyclical bull market tend to be the leaders all the way through a cyclical bull market. If this cyclical bull market were to end after 4 or 5 months, it would be the shortest cyclical bull market I can point to in history. So there are all kinds of things that could cause markets to go through a change. But it would be very unusual. The market selling off from December of 2021 through the lows in October of 22 was signaling an impact that you would see in the economy based on tightening. And we've seen some. And there's some companies that have been impervious to that. People aren't deciding to take a weight loss drug because interest rate or not because interest rates are high. There's a lot of people who have medical conditions that really need to lose weight. So we're trying to focus in companies that have something special, something changing for the better, something that can help push things higher and outperform the market. And we want to make sure that they are. And so far, the positions continue to do that. So when we look down at the sector level, as of the 10th of June, the average sector had 42% of stocks in uptrends. The weakest sectors were things like telecom and healthcare, some of the consumer groups like leisure, auto producers, the biotech sector. As of a week ago, it was more or less the same group, although the average sector had only 40% of stocks in uptrends. And this week, the average sector has 39% of stocks in uptrends, and it's basically the same groups. Although lots of these groups are now in small letters, which means that breadth has been contracting within the group. So on the far right, the sectors that have the highest percentage of stocks in uptrends, we continue to see financials, banks, insurance, Wall Street, some materials, precious metals, electric utilities, which turned up about 6 weeks ago now. We see transports. You see semiconductors, breadth is narrowed, computer breadth is narrowed, but these are the strongest groups, and the weakest groups continue to be the same groups. So what does that all mean in the portfolios? Well, cash position over the last month's gone from virtually 0 to 5%. That's across the firm. So we have a little cash weight. It's not because we decided to go out and sell a lot of things, it's because we've been stopped out of a few positions. Our financials weight is down about 2%. That was the impact of being stopped out of National Bank. Our tech weight has continued to outperform. Energy, last 2 weeks up against a weakening market internals. Industrials down a little bit. That's the impact of finning. Materials down a little bit. We came out of a position about 2 weeks ago, but still 9%, close to triple, a little more than triple weight the index. Healthcare weighting is unchanged. And then the defensive sectors really continue to have very low weightings in the portfolios because they aren't showing any new relative outperformance. So a few things just to take away. We hear about just how well the biggest stocks have done and that we've outperformed more in technology than any time since 2000. There's a big difference between now and 2000. In 2000, the top 10 stocks traded at 50 times earnings because they had very little earnings and they took a big tumble. Today, the top 10 stocks are at 30 times and their earnings are accelerating to the upside. That's a different story. If you take out the top 10 stocks, we're trading at 18 times earnings, which is not far from average. So what's happening to earnings? Well, through 2022 and 23, as the Fed was tightening and people were concerned, earnings estimates for 2024 came down pretty consistently, then flattened out. And over the course of this year, actually, estimates for this year are going higher, not lower. When we look at estimates for 2025, estimates are going higher, not lower. So it's important to remember that markets are discounting the future, not the present or not the past. Right? We went through a cyclical bear market from December of 21 through October of 22, and the market was discounting weaker earnings. Now earnings are getting revised higher. And margins, frankly, are getting revised higher. So look, there's lots of things we watch for signs of risk. We watch for signs that credit spreads are widening. They're not. We watch for signs that volatility is picking up. It's not. We have to remember that markets are driven by liquidity. And while the US may not be quite ready to loosen rates yet, we're starting to see it in countries around the world, including Canada. And when rates start to loosen, it adds liquidity to the global system, and it tends to mean that assets that benefit from more liquidity are floated higher in price. So we've talked about data where the market was up over 10% by the end of May and what happened over the course of the rest of the year. We talked about what happened in the re-election years. We've talked about years where the market was up November, December, January, February, and March. All of them pointed to higher prices for the balance of the year. We'll see. But as we sit, we think this looks very bullish. Now, we aren't adding new positions until we see the short-term data all turn back green. We're not making any bets. We're watching our existing positions very closely. But I think they're working. There's no sign at this point of some new source of market leadership. And there's no significant deterioration in the existing groups we're focused in that causes us great concern. But it's my job to worry, and we're always worrying. And we look for opportunities where things aren't working to get defensive. It just really doesn't look like now is the time. So it's coming up on the end of June. The S&P 500 companies, about 80% of them are now in their blackout period. They don't buy back shares. There's bound to be a little bit of rebalancing in portfolios for the end of the quarter. But, in general, market's in a pretty good spot. So with that, panel, if there's any questions, certainly happy to answer.
Thanks so much, David. Of course, we have questions. The first question comes from Steve. He says, David, do you use seasonality to time your entry in your positions? For example, buying the energy sector during December, which would be the weakest part of the year, and then selling it in the fall. What are your thoughts there, Dave?
Yeah, seasonality is something you always want to be aware of. However, seasonality doesn't always play out. So the old saying is sell in May and go away. That's what they say for energy. Uh, However, that's not the way it's setting up right now. The driving season is turning out to be pretty strong. And we expect next week and the week of the 4th of July, you're going to have a record month of travel in the US. So that doesn't look so weak. They also say sell the market in May and go away. But as we've talked about in previous webcasts, in a re-election year, it tends to be that July, August, September, October is pretty strong. And then 100% of the cases were positive in that last sort of 7 months of the year. So we certainly look at seasonality. The seasonality for precious metals is, weaker through the month of May and then stronger from June through the fall. Well, we have seen a little bit of a pullback in precious metals through the month of May into June. So maybe the seasonality is playing out. So we think about it, but we look at it against what's happening in the breadth models. And we're driven to make our decisions based on what's actually happening, not what we think.
Thank you, David. The next question comes from Robert. Robert asks, copper seems to be taking one step forward, two steps back ever since the price went over $5. What would be, in your opinion, the low end of consolidation for this metal? What are your thoughts there, Dave?
Yeah, so it's a great question. That's what I tried to take on in the charts this week. I mentioned that copper producers rallied about 55% the first 5 months of the year. They've pulled back about a third of that, which would be typical. So we should be into some support here. Now, liquidity is starting to pick up. That's a positive. There are higher inventories in China, but there's weak inventories in the rest of the world. It depends on, how much trade we see. But right now, as of a couple of weeks ago, we pulled back into support, and we'll see if that holds. But as it is right now, in the longer term perspective, we're seeing higher highs and higher lows. But it's not lost on me that, we pulled back really from the beginning of April. Now we are here in the middle of June. We should see some support in here. Otherwise, we might have to take our position sizes down.
The next question comes from Stephen in Toronto, and it's really about NVIDIA and how you think about trimming a position that just continues to outperform in portfolios and then grows and grows and grows in the size of the portfolios. How do we think about trimming a position that just consistently has been winning in our portfolios for clients?
Yeah, so Steve, that's a fair question. I don't know when you asked it, whether you asked it before today's webcast or not, but that was really the purpose of going through the discussion about where is it that the sector gets extended on a short-term basis, and then what happens afterwards. And basically what I tried to say is in the strongest rallies, it tends to be that the market has consolidated sideways for a period of time after you ultimately make a high, but whether that high comes from, 70% above the moving average or 100% above the moving average, we don't know when that's going to be. All I would say is this. Breadth for semiconductors is a little bit weaker, and we have become extended above the moving averages. So we have trimmed the position a couple times now. In some accounts, we've trimmed 4 times over the course of the year. And so we've maintained a position size that we're comfortable with in the portfolios, but the goal is to stay with a winning position. Who is to say that the demands being created in the very short run by AI aren't greater than any of the other cyclical rallies that we've seen over the last 20 years? Likely it probably is. And when we look at valuation, NVIDIA is cheaper today than it was a year ago based on expected earnings. So we're aware of how strong the rally's been. And it is a double-edged sword because people love the fact that it's up a bunch and they worry that it's going to go down. So, we're going to use our rules. We're going to use our rules around making sure that we see higher highs and higher lows. The fact that the stocks pulled back a little bit over the last week shouldn't be a surprise. But it certainly hasn't done any real technical damage. So we want to be aware of what can happen by looking at history. We want to be aware of what is happening based on the point figure price chart, and based on performance of the sector and the individual stock. We want to be aware of the fundamental picture, and we're not going to get it perfect, but we're trying to make sure that we maintain a prudent size position.
Thank you, David. The final question for this afternoon's program is regarding investing implications from a likely change in the government in Canada next year. Any thoughts there, Dave?
Well, not to get too political, but let's hope. Look, if we were to see a change to a more conservative government, then probably the markets are going to like that. I think you couldn't become less market friendly than it is currently. It's unlikely that the NDP are going to be elected, but I suppose anything can happen. That probably wouldn't be seen very favorably. But there is signs that we're seeing foreign buyers of Canadian energy stocks on the trading desks, more than we are seeing Canadian buyers of Canadian energy stocks. And that's a change. We haven't seen that in a long time. So that's something just to keep in mind. There are big funds picking away at large cap Canadian oil stocks, and we think they should be. I mean, that's why we're there. We really like Suncor, Imperial, CNQ. We think they're great long life assets with great dividend growth profiles, great cash flows, great share buybacks. And with a more friendly government, certainly probably you're going to see more flows in. So depending on the sector, we think that it can be a real benefit.
Thank you, David. Well, on that note, I'll leave you with the final word as always. Thanks again, Dave.
Yeah, well, I've said this a couple of times. We may see some weaker internals in the market, which means we're not buying. But there's a difference between not adding new positions and shorting a quiet market. The rule is don't ever short a quiet market. Just because the market's consolidating doesn't mean the next move is lower. I would argue it means the next move is higher. So we're hoping to hold on to our positions. When we see a period where some of the weaker stocks fall away, it's great for us because it helps us to boil down a list of companies that we'd like to own if the conditions start to improve at the sector or market level. We call that our farm team. We always have a farm team, companies that we've done our work on that are technically sound, that fundamentally look attractive. And when we see improving breadth conditions in their neighborhood, we'll look to add new positions. So it is a good time to be watching. We're just not doing a lot of doing. And that tends to be the case in the month of June. I can't tell you how often I've gone home on the eve of the Canada Day weekend, which for those out the border is more or less around the time of July 4th. First 2 weeks of July seasonally are just about the strongest 2 weeks of the year. So we want to keep that in mind. And if we get a quiet market into that point, that's okay. It's okay. Thanks everybody for joining. If you've got questions about your existing portfolios with us or your portfolios away, don't hesitate to give us a call. We're slowly building this business, and we got a lot of wonderful folks that you get to know if you don't already, and reach out by email or telephone or through the website. We're always happy to have a conversation. Pamela, thanks very much for hosting, and we'll see everybody next week.